If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness.
Hello everybody, this is Tortoise Investing. Welcome to my Dividend YouTube channel, where I talk about all things dividends all the time. Now in today's video, we're going to be going over 5 dividend stocks that you can buy and hold forever. All of these are great compounding machines with good dividend growth. None of this is financial advice. As always, do your own research and stuff before buying anything. And before we dive in, please hit that subscribe button, hit that like button, and drop a comment down below. All these things are super duper free, super duper easy to do. It makes the YouTube algorithm really happy. So let's grow the portfolios and the channel together. Now, without further ado, we're going to be taking a look at Lockheed Martin, McDonald's, Tractor Supply, Waste Management, and PepsiCo. Starting things off with Lockheed Martin. This is a strong one in my eyes. I really love this company. Just a free cash flow yield of 5.31%. It's got a dividend yield of 2.83% and a payout ratio of 43%. All those are check marks for me. It's off of its recent high of $501 back there in April 18th, down to $428. So that is about a little bit right at a 20% drop. So might be a good entry point. Do your own research. Revenue's been increasing at a rate of 5% over the last 5 years. So if we take a look here, just gradually going up as they win more and more government contracts. The free cash flow has been increasing at a rate of 25.77% over the last 10 years. That is bonkers. Again, that is just trending up and to the right. Very nice. EPS has been increasing at a rate of 9.47% over the last 10 years. Again, just kind of up and to the right. This company just is firing on all cylinders. The debt, they do have $15.4 billion in debt. Their EBITDA is $8.7 billion. When it comes to looking at this, for me, I don't like companies to have more than 3 times their EBITDA in debt, and this is definitely does not. If this was like $30 billion, I'd have an issue, but it is not that case. So the dividend, this is gorgeous. Look at this. Just over the last 10 years, up, just straight up at a rate of 10%. This is compounding. If you just hold this and let this build, like it was $1.33 in 2014 a share is what you were getting. And right now, it's paying $3 a share. So from 2014, in less than 10 years, the dividend had doubled. That is awesome to me. That is fantastic. That is just compounding. That's a compounding machine. Now, the shares outstanding have been decreasing at a rate of 1.67% over the last 10 years. They've kind of slowed things down because it is expensive compared to what it was beforehand. It is a premium. You can't tell that by looking at the PE ratio. The PE ratio is only around 15. But, yeah, I love the company. Return on capital employed has been pretty much 22% or more since 2018 onward. Even then, it was in the mid to high teens. So, yeah, Lockheed Martin, one to maybe take a look at. McDonald's, we got a just free cash flow deal of 3.19%, dividend yield 2.19%, payout ratio of 54.7%. McDonald's off a recent high of around $2.98 as of June 30th. So it is down $20 a share, down to $2.77. So that's a little bit over 10%, I believe, or close to it. The revenue has kind of been stagnant over the last bit. Let's take a look here. Yeah, it's not really going up, not really going down, but you know what is going up slowly? That free cash flow. You like to see that now. Free cash flow has been increasing over the last 5 years at a rate of 8.22%. Very nice. You like a company to have good free cash flow coming in. EPS been increasing at a rate of 5.51% over the last 5 years. Take a look at the 5-year chart here. Yep, they had their little 2020 hiccup, but a lot of things did. So I'm not going to pay that too much attention. The debt, they have $35.9 billion in debt. Their EBITDA is $9.74 billion. Yeah, this is one of the instances where they do have more debt than what I would like. But it does have a moat and a half with McDonald's. Like, this thing is resilient. So I don't personally hold this, but it does have quite a bit of debt. That's the only red flag for me, really. The dividend, let's take a look here. Dividend has been increasing at a rate of 8.52% over the last 5 years. The last dividend hike over 10%. Very nice indeed. The shares outstanding have been decreasing at a rate of 3.14% over the last 10 years. That is what I'm talking about. That is awesome. You love a company to be buying back shares. And when you see this trending downward, that's great. Do that more. Because the more shares they buy back, the bigger and bigger piece of the McDonald's pie that you get. And return on capital employed in 2020, it dropped to 15.77, and then it's right back in the 20s where it usually has been. So yeah, McDonald's, maybe something you want to take a look into. Next up, Tractor Supply. Tractor Supply off of a recent high of $245 back in April. Has just free cash flow yield 2.89%. A dividend yield of 1.97% and a payout ratio of 38.9%. We take a look at the revenue. Revenue's been increasing at a rate of 11.7% over the last 10 years. Very nice. Free cash flow right in line, 10-year average 10%. Very nice. EPS 17.72% over the last 10 years. Look at that. That is just bonkers. They do have some debt. They have $814 million in debt. Their EBITDA is $1.78 billion. No issues there. No red flags. Just a great company. Dividend's been increasing at a rate of 23% over the last 10 years. That's because of these last two gigantic, ridiculous hikes. Let's take a look here. Yeah. They took it from 52 cents a share to 92 cents a share. Like, that's your outlier. That's going to throw things off. But, yeah, the big hike, I mean, I'll take it. It didn't hurt their bottom line all that much, and it gives them a higher yield. Payout ratio is still below 40%. Shares outstanding have been decreasing at a rate of 2.57% over the last 10 years, 2.6% in the last 5 years, and over the last 1 year, 3%. They're increasing their buybacks even more. That is awesome. Look at that. Just down and to the right. That is awesome. I love share buybacks and free cash flow. It's my two big things. And have a good return on capital employed. Usually if the first two things I said are happening, your return on capital employed would be good too. 2019, they were at 18.3% on the return on capital. 2020 was 18.7, then 22.9, and then 23.47. So this is a company that's got growing revenue, growing free cash flow, growing dividend, decreasing their share count, and a growing return on capital employed. Just check marks all around. Next up, Waste Management. Waste Management off a recent high of $173 down to $159. Just free cash flow yield 2.2%, dividend yield of 1.74%, and a payout ratio of 48.6%. Revenue's been increasing at a rate of 6.34% over the last 5 years. And you can see here, it's a nice little trend line going on. Free cash flow has been increasing at a rate of 9.52% over the last 10 years. Again, nice little trend line going on there. Some growth going on. EPS has been increasing at a rate of 11.84% over the last 10 years. Growing EPS usually a sign of a growing company. Debt $14.5 billion. Their EBITDA is $5.4 billion. No issue there. And the dividend. The dividend's been increasing at a rate of 6.73% over the last 10 years, but it looks like here lately they have been doing bigger hikes. So over the last 5 years, 8%. The last 2 years, 10% average. So that is very nice. Looks like things slowed down a little bit, but it's taken right back off again. These stairs are getting steeper and steeper. Shares outstanding over the last 10 years, a rate of 1%. And it looks like they just consistently here and there buy back shares, which, again, I like. They've decreased their share count. Let's see here. Let's go back 10 years in 2013. 469 million down to 415 million. So Slowly and steadily, they're buying a million shares here and there. It makes a difference over time. And return on capital employed in 2020, they had a drop 9%, of course, like everything in the world did. 2021, 11.8%. In 2022, 12.4%. So the return on capital employed is growing again. Again, this is a very resilient company. Waste Management is one of those, I'm not going to say recession proof, but recession resistant. So this is something that's just, it can weather the storm. And lastly, a PepsiCo off a recent high of $196 down to $177, down almost $20. That's over 10%. Just free cash flow yield 2.19%. Got dividend yield 2.69%. A payout ratio of 82%, a little bit on the high side, but it's PepsiCo. I know they're going to sort things out. Revenue's been increasing at a rate of 6.34% over the last 5 years. It looks like they got some rapid growth going on there. Let's take a look at that a little bit deeper. Yep, this is going up quicker over the last 2 years, a rate 10.8%. Very nice. Free adjusted cash flow, not really been growing, but it's not really been dropping either. It's kind of just been hovering around in this area for the last 10 years. I mean, hey, that's okay. Shares outstanding. They're giving out some shares, but it's not impacting them. It's nothing crazy. EPS been growing at a rate of 13.69% over the last 5 years. Very nice. And the debt is $35 billion. EBITDA is $14.7 billion. Again, no issues there in my eyes. Again, my personal opinion when it comes to all that. Over the last 10 years, dividends been increasing at a rate of 8.34%. Just again, very nice little set of stairs you got going on. The last dividend hike was 10%, so they are increasing the quickness of those hikes. Again, just great compounding. Shares outstanding have been decreasing at a rate of 1.26% over the last 10 years, but here lately they've not really been buying back shares since 2019. But that's okay. They think the company is at a premium price. Don't be wasting your money buying back expensive shares. And the return on capital employed, 2020 was 14.4%, 2021 16.8%, 2022 17.6%. So return on capital employed is growing, dividends growing, revenues growing, EPS growing, everything's growing. Very nice. So those are 5 strong dividend companies in my eyes. Again, as always, make sure to do your own research and stuff just before buying the thing that I've listed off. And let me know down in the comments below. Let me know what you think about the new thumbnails. I've been trying to mix things up a little bit here lately. But yeah, hope everyone takes care. See yous.